What if I told you that a company made almost 80 crore rupees in cash, put it exactly where everyday common sense tells you it belongs, and in doing so just completely violated international accounting standards?
I mean, it sounds crazy, right? But it happens.
It really does. So welcome to a brand new episode of the GAAP Advisors Ind AS Clinic podcast. Today, on this deep dive, we are basically acting as financial detectives.
Oh, definitely. The best kind of detectives.
Right. So for you listening, our mission today is to unpack a real-world accounting mystery. And we pulled this directly from the published financial statements of a listed company.
Yeah, these are real numbers out in the wild.
Exactly. Okay, let's unpack this. We have an observation, we have an actual image of a company's financial notes, and we have the rule book, specifically Ind AS 109.
The big one.
Yeah, the big one. And we are going to figure out exactly where the numbers went wrong and, more importantly, why those seemingly minor missteps can just completely distort an investor's view of reality.
It's really the perfect case study, I think, for exploring that friction between cash flow reality and accounting theory.
For sure. But before we jump into the specific numbers, we need to set the baseline rules, right?
Right. We need to establish the parameters of the financial environment we're looking at today. So for the purpose of this analysis, the functional and presentation currency is the Indian rupee, INR.
Okay, got it.
Therefore, any currency that is not the functional currency is considered a foreign currency.
Makes sense.
Furthermore, the reporting period we are looking at begins on the 1st of April and ends on the 31st of March.
Okay, so those are the ground rules for the environment. Anything else before we dive in?
Yes, actually, we have a very critical disclaimer to set the professional boundaries here. The views expressed in this deep dive are the personal views of the author of our source material, and they are not binding on the audience.
Right.
Listeners are strongly requested to seek the help of a qualified expert before taking any action or, refraining from any action based on the views discussed herein.
Absolutely. I mean, we are looking at the architecture of the rules here, right? This is an exploration of accounting principles, not personalized financial advice.
Exactly.
So, for context, the specific observation we are dissecting today, it was actually featured in the 209th edition of the GAAP Advisors Task Weekly newsletter.
Which is an incredible resource, by the way.
Oh, it really is. It's authored by C.A. Manish, the director of GAAP Advisors, and published on LinkedIn. They've actually published over 230 editions to date.
Over 230.
Yeah. So if you are on LinkedIn, I highly recommend you subscribe to the newsletter for free.
The consistency of that publication really provides a window into the kinds of errors that routinely slip past initial reviews.
Yeah, which brings us to the core tension of this entire discussion, I think. We are about to get really deep into the weeds of Ind AS 109.
We definitely are.
We'll be analyzing specific paragraphs, looking at the mechanics of financial statement notes. And, a sophisticated listener, maybe someone who manages their own portfolio or an analyst, might wonder why they need to care about this.
Why get into the granular methodology, right?
Exactly. Why should any person investing their hard-earned money in the shares of a listed company need to deeply understand accounting standards? Like, why not just trust the top-line revenue and the bottom-line profit?
Because trusting the bottom line number without understanding the standard used to calculate it is essentially flying blind.
Wow. Flying blind.
Completely. If we connect this to the bigger picture, accounting standards aren't just red tape. They are the actual lens through which a company's true economic health is viewed.
Okay, so if the lens is warped.
Right. If that lens is warped, or if the preparer of the statements applied the wrong standard to a transaction, your perception of value as an investor is fundamentally distorted.
That makes total sense.
You might look at an earnings report and see, a massive surge in core operational revenue.
You'd think they're killing it.
Exactly. You think they're capturing unprecedented market share. But if you actually understand the accounting standards, you might realize that surge wasn't from selling more products at all.
Wait, really? What else could it be?
It might merely be a reclassification of a financial instrument's cash flows, or a one-time structural adjustment that's actually masking a decline in core business volume. The standard dictates the reality you're allowed to see.
Okay, let me try to put that into a physical analogy for a second. Looking at a balance sheet without understanding the accounting framework is, it's like looking at the exterior of a massive office building.
Okay, I like this.
You see a fresh coat of paint, Gleaming windows, a beautifully landscaped lobby. It looks like a premium asset.
Right.
But the accounting standards, those are the architectural blueprints and the structural engineering reports.
Yes, exactly.
They tell you if the foundation is sinking or if the load-bearing walls are compromised. The building might look identical from the street, but its true value is entirely dependent on what's beneath the surface.
That is a very apt comparison.
Mhm.
And, the observation discussed today wasn't flagged by a regulator or a whistleblower. No, it was discovered during a suo moto independent review of published Ind AS financial statements by GAAP advisors.
Suo moto, meaning they just took the initiative to look themselves.
Yes, they downloaded publicly available data and analyzed it purely on their own. The fact that a non-compliant presentation made it all the way to a published audited statement, well, it highlights how easily these structural misapplications happen.
Which means as an investor, your baseline assumption shouldn't just be blind faith in the printed numbers.
It absolutely cannot be. If you invest in a listed company's shares, a review of the company's financial statements for Ind AS compliance can critically help you.
Help you decide whether to buy, hold, or sell.
Precisely. You're looking for anomalies, places where the numbers don't logically flow according to the strict mechanics of the framework.
Okay, so let's bring that directly to the anomaly we are investigating today. We are looking at a specific section of a real company's financial statement, Note 26.
Ah, yes. Note 26.
The heading of this note is literally fees and commission income. And below that it says, on the basis of nature of services, the company's revenue from contracts with customers are, and then it gives a breakdown.
And that categorization itself is our first vital clue.
How so?
Well, by placing these items under fees and commission income, and specifically referencing revenue from contracts with customers, the company is making a distinct assertion.
They're saying they performed a service.
Right. They're saying, we performed a service, and we were compensated for that discrete service.
Okay, so looking at this note 26, one major anomaly jumps right off the page. The very first line item, Roman numeral 1, is listed as prepayment premium on loans.
Yep, there it is.
And for the year ended 2020, they reported 79.58 crore rupees. In 2019, it was 107.27 crore.
That is a massive amount of capital.
It really is. They essentially booked nearly 80 crore rupees of prepayment premiums and tossed it straight into their fees and commission bucket.
Just dropped it right in there.
Yeah. And the rest of the note contains items like fee-based income on loans, which was 43.38 crore, and fee for implementation of Government of India schemes, which was nil for 2020.
So the total for the entire category was 122.96 crore in 2020.
Exactly. But the row that triggered the investigation is that 79.58 crore.
The prepayment premium on loans sitting boldly under that heading.
Okay, I have to play devil's advocate here.
Go for it.
If I am the bank and a borrower comes to me and says they want to pay off their commercial loan 5 years early, my instinct is to charge a penalty, a premium.
Sure, you're losing future interest.
Right. I'm losing out on 5 years of expected interest, so I charge a fee to break the contract. Cash changes hands. The borrower pays me a premium, I put that cash in the bank. Why can't I just recognize that as revenue right now?
It seems perfectly logical.
Right. To a normal person, it's like, it looks like income, it acts like income, why shouldn't it be listed right here?
Your logic tracks perfectly with standard operational business thinking. Cash came in, a specific event triggered it, so it's a fee for that event.
So what's the problem?
The problem is that the architecture of financial instrument accounting requires a much more rigorous look beneath the surface. It fundamentally rejects the idea that a loan is just a series of disconnected cash events.
Oh, interesting. Disconnected cash events.
Exactly. To understand why your assumption, while practically intuitive, is technically completely incorrect, we have to open the rule book.
Okay, let's open it. Ind AS 109.
Yes. We have to dive into Ind AS 109, which governs financial instruments.
Let's do it. Where do we start?
We begin with the foundational concept that governs how these assets are measured on the balance sheet. In Appendix A of Ind AS 109, there is a definition for the effective interest rate.
The effective interest rate. Okay.
This definition is the absolute bedrock of amortized cost accounting.
Lay it on me.
The standard defines it as the rate that exactly discounts estimated future cash payments or receipts through the expected life of the financial asset or financial liability to the gross carrying amount.
Okay, let's pause and translate that, because exactly discounts estimated future cash payments is a wall of jargon.
It is a bit dense, I admit.
So what does this all mean in practice? Let's try to visualize it. If I loan someone 100 million rupees, I don't just book 100 million out and wait to see what happens.
Right.
No.
Absolutely not. You build a comprehensive mathematical model of the entire expected life cycle of that loan from day one.
Right. It's almost like setting a financial metronome.
A metronome. I like that.
Yeah, think of the effective interest rate like a financial center of gravity. When the loan is originated, the bank maps out every single rupee they expect to receive. Principal, interest, fees.
They map all of this out over the expected life of the loan.
Exactly. And the effective interest rate is the specific percentage, the gravitational pull, if you will, required to take all those future cash flows over 10 or 20 years and pull them back to equal the exact amount handed out on day one.
It binds the entire timeline of the asset into a single cohesive yield. That is a highly accurate way to conceptualize it.
Okay, so where do prepayments fit into this gravity?
Well, the standard is very explicit about what goes into determining that rate. It states that you shall estimate expected cash flows by considering all the contractual terms of the financial instrument.
All the terms.
Yes, it specifically lists examples: prepayment options, extension options, call options.
Ah. So this is the crucial point where the bank's common sense defense falls apart.
Completely falls apart.
Because a prepayment isn't an unforeseen random surprise. When the bank originated the loan portfolio, their actuaries already mathematically anticipated that people would prepay.
They did. They modeled the probability of early termination, and they modeled the cash premiums they would receive when those terminations happened.
So those estimated prepayment premiums were already baked into the effective interest rate from the start.
Exactly. They were baked in. The standard dictates that the calculation includes all fees and points paid or received that are an integral part of the effective interest rate, including premiums.
So the prepayment premium is not a separate service.
No, it is an integral component of the overall yield.
It's already in the soup. You can't suddenly fish it out 3 years later and call it a side dish.
That's a great way to put it. You can't fish it out. But there is a very interesting exclusion in the standard regarding this initial calculation.
Oh, what's excluded?
The text mandates that while you must consider prepayments and call options, you shall not consider expected credit losses when estimating these cash flows.
Wait, really? Expected credit losses are excluded.
Yes, that is a vital distinction in the architecture of Ind AS 109.
But why the separation? I mean, if I'm lending money, my two biggest variables are when will they pay me back and will they pay me back at all?
Timing risk and default risk.
Exactly. So why is timing risk baked into the core interest rate, but default risk is completely excluded from that initial center of gravity?
Because mixing them would cause catastrophic double counting of risk. It would distort the reality of the balance sheet entirely.
How so?
In AS 109, utilizes an expected credit loss, or ECL, model for impairment. This requires entities to constantly assess and recognize credit risks separately based on forward-looking information.
Okay, so it's a separate bucket.
Exactly. The effective interest rate is about allocating the contractual yield and structural cash flows over time, assuming the borrower actually performs.
Ah, I see.
If you embedded expected credit losses directly into the effective interest rate, you would artificially lower the initial gross carrying amount of the asset. And
Yes, you'd hit the income statement again when you actually recognize the impairment provision under the ECL model.
Bingo. You would essentially be penalizing the asset twice for the exact same risk.
That makes total sense. You keep the effective interest rate focused on the structural mechanics, extensions, prepayments, and deal with defaults in a completely separate bucket.
It allows the investor to see exactly what is driving the performance. Is the yield changing because borrowers are prepaying? Or is the portfolio deteriorating because people are going bankrupt?
That separation provides immense clarity. Now, the standard does include a caveat about rare cases, right?
Yes, it does.
It operates on the presumption you can reliably estimate these things. But what happens in a chaotic environment? What if you just can't reliably estimate when people will prepay?
The standard has a strict fallback mechanism. In those rare cases where it's not possible to reliably estimate cash flows, the entity must use the contractual cash flows over the full contractual term.
So you just throw the behavioral modeling out the window and stick rigidly to whatever the legal document says?
Yes, you default to the strictest legal interpretation to the absolute final day of the contract. It removes the opportunity for arbitrary manipulation.
Okay, so let's bring this theoretical framework back to reality, back to our listed company and their note 26.
Right, back to the 80 crore.
We've established that the effective interest rate mathematically incorporates estimates of prepayments. But economic realities change.
They always do.
Say they anticipated a 5% prepayment rate, but then central banks slash interest rates globally. Suddenly, 25% of the portfolio is prepaying to lock in better rates.
That's a massive shift in the underlying economics.
The rhythm is broken, the center of gravity is thrown off. So how is a company supposed to handle this curveball? Do they just sweep the difference into a fees bucket?
Well, the company we are analyzing clearly thought so. They looked at this influx of cash and dumped it straight into their income statement as fees and commission income.
Recognizing 79.58 crore immediately.
Right. But to explain why that breaks the rules, we need to look at paragraph B 5.4.6 of Ind AS 109. What's fascinating here is that this paragraph dictates exactly what to do when reality deviates from the estimate.
Break down B 5.4.6 for us. What is the mandatory protocol?
It states that if an entity revises its estimates of payments or receipts, the entity shall adjust the gross carrying amount of the financial asset.
Wait, adjust the gross carrying amount. That's the smoking gun right there.
It is. It explicitly targets the balance sheet asset value. It does not say, recognize the difference as fee income.
So how does the math actually work?
The entity must recalculate the gross carrying amount as the present value of the estimated future contractual cash flows.
Okay, let me stop you there and build a numerical example so we can really visualize this. Let's say a bank has a loan portfolio with a gross carrying amount of 100 crore rupees.
Okay, 100 crore.
The original effective interest rate was 10%. 2 years in, a massive wave of prepayments hits. The bank gets a 5 crore rupee prepayment premium today,
Right.
and they realize the remaining life of the loan is going to be much shorter. What does paragraph B 5.4.6 force them to do in that exact moment?
It forces a complete recalculation of the asset's present value. They cannot simply take that 5 crore premium and book it as revenue for the quarter.
They have to look at the new timeline.
Yes, they must look at all the remaining cash flows they expect, the new, shorter timeline of principal and interest payments.
And here's the crucial variable. What discount rate do they use to pull those new future cash flows back to a present value today? Do they use the current market rate, say it dropped to 6%?
No. And that is a very common misconception that violates the amortized cost model. The standard mandates that these revised cash flows must be discounted at the financial instrument's original effective interest rate.
Ah, the original center of gravity.
Precisely. They must use that original 10% rate to discount the new revised cash flows back to today.
So let's say that new present value calculation comes out to 98 crore rupees.
Then the bank must adjust the gross carrying amount on the balance sheet from 100 crore to 98 crore.
They have to physically change the value of the asset sitting on the balance sheet.
Yes. The adjustment happens on the balance sheet first. It is a structural realignment.
Okay, but I want to push back on this. Let's look at it from a pragmatic corporate accountant's point of view.
Fair enough.
I am looking at the final sentence of paragraph B 5.4.6. It explicitly states the adjustment is recognized in profit or loss as income or expense.
Yes, it does.
Here's where it gets really interesting. The company in our case study did recognize the 79.58 crore in profit or loss. They put it in note 26, which flows directly into the income statement.
They did.
So didn't they arrive at the correct final destination, even if they bypassed the balance sheet to get there? Why is GAAP advisors calling this out as a failure?
This is a defense we encounter frequently in practice. The argument that the net profit is the same, so presentation doesn't matter.
Right. No harm, no foul.
But in financial reporting, the journey, the categorization, the structural mechanics, they are just as vital as the final number.
So what's the verdict?
The verdict on Note 26 is unambiguous. The company recognized the prepayment premiums directly as fees and commission income. They skipped a vital step. They bypassed the entire recalculation of the gross carrying amount on the balance sheet.
They took a massive shortcut. Cash came in, cash went straight to the income statement.
Exactly. The adjustment to profit or loss mentioned in B 5.4.6 is meant to be the mathematical result of recalculating the balance sheet. It's a plug figure representing the change in present value.
It's not meant to be a direct booking of raw cash received as an independent fee.
No, it is not. And this raises an important question. Why does this structural shortcut matter so deeply to the reader of the financial statements?
Yeah, if the earnings per share is roughly similar, why does it matter if it went through the balance sheet first?
Because bypassing the balance sheet misrepresents the true carrying amount of the financial assets. It obscures the true economic performance of the loan portfolio.
Back to the building analogy.
Right. If a bank is just dumping prepayment premiums into fees and commission income, the investor is completely blinded. They can't tell if the core lending business is generating steady yield or if they just had a one-off spike because borrowers are breaking contracts and fleeing.
It completely distorts the yield.
It distorts the effective interest rate of the portfolio as presented to the public. It muddies the waters. By classifying it as a fee, the company is signaling that a separate, distinct service was rendered.
But no separate service was rendered.
Exactly. This cash was merely a modification of existing contractual cash flows. Therefore, the company has not complied with the requirements of Ind AS 109.
Wow. That distinction really alters everything about how you evaluate a company.
It does.
If I'm an analyst and I see fees and commission income skyrocketing by 80 crore, my model assumes their advisory or wealth management business is booming.
You'd project that growth forward.
Exactly. But in reality, their loan book is just shrinking rapidly as people prepay. Those are two completely different business realities masked by one incorrect presentation.
And I think it's essential for our listeners to understand the global application of this.
Yes, let's talk about that.
We've been framing this under Ind AS 109, but there was no fundamental difference between Ind AS and IFRS, the International Financial Reporting Standards, for this specific topic.
So an auditor in London or Toronto would be looking for the exact same misclassification.
Absolutely. This entire discussion is equally applicable to all entities following the IFRS framework globally.
That universal application really underscores the gravity of these rules. A seemingly minor categorization error can have a massive impact. And it makes me think about the immense pressure on auditors.
The burden on audit teams is truly extraordinary today. They have to verify the complex theoretical application of these mathematical standards to every single transaction.
Right. If you're an auditor and the client says, we booked this 80 crore as a fee, leave it alone, you can't just nod. Documenting exactly how you addressed an issue on the application of Ind AS is incredibly difficult.
You have to document the conceptual framework, the mathematical proof, the specific citations.
Relying on internal knowledge isn't enough anymore, which is why professional resources are so critical.
I strongly agree. And for professionals grappling with these precise types of technical dilemmas, the issue repository on GAPadvisors.com is just an indispensable asset.
The scale of what they have there is remarkable. Over 4,500 specific issues and their detailed responses on Ind AS and Indian GAAP.
4,500 real-world mysteries solved.
And any person can register for free, right?
Yes. Any person can register for free. You aren't just reading old case studies. You can submit your own specific issues. If you're an auditor staring at a complex B5.4.6 scenario, you submit it.
And a detailed response is delivered directly to the inbox of the email you registered with.
Exactly. It's incredibly helpful, particularly for auditors who need to rigorously document how they addressed an issue in their audit files.
It provides that intellectual structural engineering report to back up your decisions. But from the company's perspective, this 80 crore misclassification was found in a published statement. It was already out there.
Which exposes the company to immense regulatory and reputational risk.
Right. So companies must get their financial statements reviewed by GAAP advisors before signing them. You want an expert catching these anomalies before the board signs off.
It acts as an essential quality control mechanism. Financial statements can be submitted in a near-to-publishing PDF format by email to info@gapadvisors.com.
And for those needing immediate personalized guidance on really complex issues, you can actually book a one-on-one consultation with the author, C.A. Manish-C.Iyer.
Yes, directly from his page on topmate.io. It provides a space to verbally untangle the most complicated reporting structures.
That ability to whiteboard a problem is invaluable. Well, as we reach the conclusion of this deep dive, we've journeyed from a simple Note 26 deep into the mathematical theory of effective interest rates.
It really reinforces the reality that accounting is not merely bookkeeping.
No, it's the language we use to translate complex economic behavior into truth.
And on that note, I want to leave our listeners with a final provocative thought to ponder.
Oh, I love these. Let's hear it.
If a seemingly straightforward event, like a customer paying off a loan early and handing over a premium, can trigger a complex recalculation of the gross carrying amount using the original effective interest rate, how many other routine line items in a company's revenue stream are actually masking deeper required balance sheet adjustments? Are the numbers you are looking at telling the story of an asset's true life cycle, or are they just a convenient shortcut?
Wow, that completely changes how you evaluate an annual report. Are we looking at the blueprints or are we just admiring the paint?
Exactly.
Thank you so much for walking us through this incredibly complex landscape today.
It was a privilege to unpack the architecture of these standards with you.
And thank you to our audience for dedicating your time to this deep dive. Navigating Ind AS 109 is a heavy lift, and we appreciate you staying with us. If you found this valuable, we request you to follow or subscribe to the GAAP Advisors Ind AS Clinic podcast on Spotify, Amazon Music, or YouTube.
Whichever platform you prefer.
Right, whichever you prefer to listen to GAAP Advisors and Ind AS Clinic podcasts on. Finally, we urgently request you to share this podcast among your contacts, colleagues, audit and finance teams, and especially students pursuing their CA course.
It really helps spread the vital knowledge of Indian accounting standards.
It absolutely does. Until next time, keep questioning the numbers and never settle for the shortcut.